Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, September 4th, 2024. Hope you're having a fantastical day out there in the interwebs. It was nice outside. Got kind of gloomy this afternoon. Looks like we got some rain and some cooler weather headed towards us. I think tomorrow the high's in the 60s, so not terrible. Anyways, hope you're having a great day out there. Markets, not in the best mood. They turned south midway through the day, and looks like only the Dow has managed to squeak back into the green. So, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All righty. Let's get into the numbers for today. Dow Jones up 0.09%, 38 points, closed at 4974. S&P 500 down 0.19%, 10 points, closed at 5518. NASDAQ down 0.31%, 53 points, closed at 17,082. The VIX was up 2.32% today. It's at 2120. Canada flat down 0.01. Brazil up 1.57%, and Mexico up 0.48. Over in Europe, Germany was down 0.83, the UK down 0.35, France down 0.98, Netherlands down 1.31, Spain down 0.58, Italy down 0.54, Switzerland down 1.48%, and Portugal up 0.49. Lone bright spot in Europe. Russian exchanges, both green today. MOEX up 3.15%, RTSI up 2.78%. And the overnight, the Nikkei was down 4.35%, Australia down 1.88%, New Zealand down 0.45%. In China, the Shanghai was down 0.67%, the Shenzhen Component down 0.51%, China A50 down 0.7%, DJ Shanghai down 0.53%, Hang Seng down 1.1%, and the Taiwan weighted down 4.52%. So a lot of red on our screens today. I guess, folks are waiting to see what the Fed's going to do next week. Everyone's in anticipation mode of lower interest rates because, lowering rates, 0.25%, it's going to save everything. It's going to solve all of our problems. We're going to have unicorns running up and down the streets. Santa's going to come on Tuesdays. Everything will be fine. All right, let's get to the market recap. Stocks fall with safe haven assets in demand, growth concerns in focus. Global equities and oil prices fell on Wednesday, while safe haven assets like U.S. Treasuries and the Japanese yen saw increased demand as mixed economic data fueled concerns about slowing growth. Crude oil prices declined for the third consecutive day, including a sharp 4% drop on Tuesday. U.S. Treasury yields also fell, with the closely watched yield curve between the 2-year and the 10-year notes turning positive after U.S. job openings dropped to a 3.5-year low in July. Well, let me bring up the yield curve chart and see what we got here. We can bring this over here on the screen and make that bigger. So we can see on the short end of the duration, still pretty high. Comes down. Right now it says it's flat. So the 2-year, see, that's the 3-month, 2-year, 5-year. So the 2-year is slightly below the 10-year, I guess. So I guess in their mind, that means it's no longer inverted. This does not look good, unfortunately. So if you're looking at that, it's supposed to start down here on the left-hand side, on the short end, and go like this, kind of like in a little half rainbow. This is bad. So, and if we go back through time, we've had this inverted curve going on until see, that's more normal right there. That's a normal curve. See, when was this? February of 22. That was 2 years ago, folks. So we've been in this situation with an inverted curve, basically for 2 years, and not a good thing. And if we go back to 2019, where is it? Right there. We had a pretty ugly curve. It still said it was normal, but we had a bit of an, looking at this in the 5 years ago at this time, this was not a good curve to look at. So, all right, let's close that down. Oops, I didn't mean to do that. All right, let's get back to my notes. Where was I? 3.5-year low. All right. This data suggested weakening labor market conditions, leading traders to speculate that the Federal Reserve could cut interest rates by as much as 50 basis points. That's 0.5% for normal people at its upcoming meeting, which is next week on the 17th and 18th. U.S. stock indices or indexes experienced volatility with the S&P 500 fluctuating between gains and losses. Investors are cautiously awaiting key economic data later in the week, including a U.S. services sector report and jobless claims on Thursday, followed by the much-anticipated non-farm payrolls report on Friday. This data is expected to provide critical insights into the state of the U.S. economy and influence the Fed's next move on interest rates. The dollar weakened against major currencies, particularly the yen, as investors bet on larger rate cuts. U.S. crude oil prices continued to decline amid concerns about demand and mixed signals from producers regarding future supply. Meanwhile, gold prices gained, benefiting from a softer dollar and lower yields. Overall, markets remained on edge, with investors shifting focus from inflation to the weakening labor market as a key concern for the U.S. economy. Well, that's some awesome news, isn't it, folks? Let's dive into a little bit of data here. The July International Trade Report. This comes to us via First Trust. Mr. Strider Elas, senior economist, is who put this report together. All right. In July, the U.S. trade deficit in goods and services expanded to a two-year high of $78.8 billion, driven by imports growing faster than exports. However, a key takeaway is the increase in total trade volume, imports plus exports, by $8.4 billion, reflecting an overall rise in cross-border business and consumer activity. Could be as things are more expensive. Probably due to all the inflation, which is due to all the money printing from the Federal Reserve and our governments. So, total trade volume is up 6.9% year over year, with exports increasing by 5% and imports rising by 8.4%. Excuse me. Part of the import surge is attributed to companies stockpiling ahead of a potential dock worker strike on the East and Gulf Coasts. Additionally, a notable shift in U.S. trade patterns has emerged. Imports from China are flat compared to 2023. And down 24.8% from 2022. China, once the largest exporter to the U.S., now ranks third, with Mexico taking the top spot and Canada in second place, because we got to get all that maple syrup in Molson. Let's see here. Global supply chain pressures have significantly eased, as confirmed by the New York Fed's Global Supply Chain Pressure Index, which was slightly below its historical average in July, a sharp contrast to the elevated pressures seen 2 years ago. Furthermore, the U.S. remained a net exporter of petroleum products for the 26th consecutive month as petroleum exports exceeded imports. All right. I don't understand. Well, I mean, it may just be the different grades of petroleum is the reason we have to import. I mean, I would imagine we probably have most of it here. But again, I'm not an oil and gas expert, so I couldn't give you those definitive answers. But it makes me wonder, is like, don't we have enough oil under the ground? I mean, I know why. There's a lot of wealthy people out there who own all this oil or oil rights, and they want to hold on to their asset. And it's easier to let the world pump it out of their ground and bring it here, and they get to hold on to their asset, and the asset goes up in value as the oil prices go up in value, and they don't have to do anything. So anyways. All right, one last article comes from Zero Hedge. Ugly Beige book reveals economic activity flat or declining, consumer spending slowing in most districts. All right, the latest Beige book report from the Federal Reserve, released 1 week after Q2 GDP revisions, showed a strong 3% growth rate, presented a more subdued picture of the U.S. economy. Economic activity grew slightly, and that's in quotes, in only 3 of the Fed's districts, while 9 reported flat or declining activity, an increase from 5 in the previous period. This suggests the economy may not be as robust as recent GDP figures indicate. The labor market was also sluggish, with firms only filling essential positions and reducing hours or employment through attrition. Layoffs Layoffs remained rare and wage growth was modest, but companies became more cautious about hiring, citing concerns over demand and economic uncertainty. Consumer spending, a key driver of economic growth, declined in most districts. Auto sales were mixed and manufacturing activity weakened further, continuing a trend of contraction across multiple sectors. Residential and commercial real estate activity showed signs of softening, with home sales in decline in most regions. The report indicated that inflationary pressures are easing, with prices increasing only modestly. Some districts saw reductions in costs of food, lumber, and concrete, though freight and insurance costs continue to rise. Looking ahead, most districts expected stable or slightly improved economic activity, but several anticipated slight declines, particularly in the labor market. The report underscores the uncertainty surrounding the economic outlook, with mixed signals about growth, inflation, and employment. So that's more of the same. Unfortunately, it's kind of cloudy in front of us. Really don't. I mean, I don't know. I can't really say that I know for sure, but if I were to be a betting man and I wanted to put a wager on some, I think we're headed in a downward trend, simply because, and here's my hypothesis, we were supposed to go through a downtrend in 2020, and all that COVID money just made it disappear. I mean, basically all it did was inflate the economy and put some patches over the potholes in the road. But, we've had 3 or 4 years now of people driving across those roads in winters and things like that. And, now the potholes are worse than they ever were. And that quick fix, unfortunately, while it made the road smooth for a year or two, is going to, get real bumpy here in the upcoming future. So again, that's my hypothesis. All we did was delay that downward market cycle until sometime now or in the future in front of us, which I personally would have rather gone through it back in 2020, but no one wanted to be in no one wanted to be in office or in the administration when things fell apart. But at the time I was like, well, maybe Trump was pretty smart by not winning, or letting the other people manipulate things, or what's the word? There's that Time magazine article that talks about how they influence the election, or, basically massage things. Basically, what got disseminated out to the public was half-truths and things like that. So anyways, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So feel free to give me a buzz, and I'll be happy to help. All right. Well, I hope everyone has a wonderful evening, and I shall be back tomorrow with more of the fantastical, amazing news that will be disseminated then. Adios. Have a great night.